Hi, I'm Sebastian Mullins, head of multi-asset and fixed income at Schroders Australia. The market continued to be volatile in the fourth quarter of the year as markets try to digest what a Trump presidency means for asset classes. Global equities eked out a small gain of 1.3% in local currency terms, and Japan was the best region, up 5% in Japanese yen terms over the quarter, with emerging markets suffering the most, down 8%, given the threat of tariffs from a Trump presidency. That was led lower by Latin American equities, which are down 16%, as Trump, straight off the bat, already announced tariffs on Mexico. Equities in the US had a pretty strong run until they started to fall towards the end of the quarter. Over the whole quarter, they're only up 2.3%, but at one point they're up 7% on the news of a Donald Trump victory. At first, more value-oriented stocks or small-cap stocks in the US rallied. By the end of the quarter, the Mag 7 continued their dominance. The reason the market started to fall towards the end of the quarter is because interest rates are expected to be higher than anticipated. In fact, Donald Trump brings growth, but also inflation, to the US economy. And that came through in the Fed minutes when they had a hawkish cut. Bond yields rose by 80 basis points over the quarter to get the 10-year Treasury to yield 4.6% by the end. This pushed up the US dollar quite substantially against most currencies. The Aussie dollar fell the most, down 10% over the quarter, followed by the Japanese yen, down 8%, and the euro down 7% versus the US dollar. Thanks to government intervention, the Chinese yuan only fell 4.5% over the quarter. Finally, credit spreads did really well. They tightened substantially. Looking at US credit, for example, spreads there got to tights not seen since before the GFC, back to levels in the 2000s. So quite strong outperformance of credit relative to duration. The Schroders real return wholesale class delivered 2.1% net of fees over the quarter, bringing the one-year return of 2024 to 10.8% net of fees. Foreign currency were actually the main contributor to returns over that period, as the Australian dollar fell quite substantially over the quarter. Our allocation to US dollars, Japanese yen, actually protected the portfolio as the Aussie dollar fell. Global equities also contributed to performance, especially the US equities and Japanese equities, and things like insurance-linked securities and Australian high-yielding corporates also added to performance. The main detractor was duration, given bond yields sold off across the board. However, our allocation to, first of all, low overall duration and being underweight US duration protected the portfolio, as we allocated to countries like Australia and Germany, which outperformed, and also the front end of the curve, which also outperformed, limiting the damage to the portfolio. The main question we've been asking for 2025 is, will growth trump inflation? US growth has been stellar over the last year, outperforming every other country in the world. So when we look at 2025, first question we have is whether growth will continue to do well. Now, growth was doing well before Donald Trump came into the picture. We saw growth above trends at around 2.7, 2.8% for 2024. We're still waiting on the final numbers, but that is above what we saw in the last few years. That was driven by very strong consumers who were spending as opposed to government stimulus. We've also seen the unemployment rate stay low at 4.1%. Consumers continue to get real wage growth. You're seeing corporates actually deliver above expectation on earnings. You've seen the Federal Reserve start to cut rates. All these things are quite positive for the US economy, and we do expect the US economy to grow. Now, Trump turbocharges that. His policies are pro-growth when discussing things like deregulation and also tax cuts, but it also comes with a bit more inflation than markets might be anticipating. If you look at this slide, you can see on the left-hand side that our expectations for growth next year is around 2.5%, slightly down from this year, but above trend. Most of his policies will come through, we think, towards the end of the year, giving 2026 more likelihood of a higher growth of 2.7%. Again, higher growth than the rest of the developed markets during these timeframes. What the market might not be anticipating is that Trump's protectionist policies, such as tariffs and immigration, are likely to push up inflation in the US. So we don't see inflation falling down below 2% anytime soon. You can see on the right-hand side some of those contributions keep inflation above the Fed's target of 2%. Now, what that means for Fed funds rates, we shall see in a moment. However, for us, the question remains, will growth trump inflation? One of the main things clients and everyone is asking is whether tariffs will lead to inflation in the US. Will that complicate the Fed's job of bringing rates down below 2%? Thankfully, there are some offsetting factors. Here you can see a graph during the last Trump presidency when the trade war actually occurred, and it didn't actually lead to higher inflation. The reason why is there's some offsetting balances. For example, the country exports to the US will see their currency fall. You can see some reshoring, where they take off the Made in China sticker, maybe put on Made in Korea, Made in Vietnam, to get away with some of the sanctions, so I should say tariffs. And also some of the exporters will actually see their spreads, or I say their margins, contract. So rather than seeing the consumer in the US pay up, actually some of the pain comes to those exporters in those countries. So we don't think it'll push inflation up significantly higher, but it does mean that countries like China will probably suffer. And the problem is China is already suffering. Growth there continues to be weak, weaker than expected. And you can see on the left-hand side how they're trying to derive their growth. Very, very weak consumer sales, retail sales, I have to say, have been low. Confidence on the right-hand side for consumers in China is very low. And that's because most of their wealth was in property, and property's fallen. So they're now trying to delever their balance sheets by saving money to pay off their debt as opposed to spending. Fixed direct investment from overseas has also dried up. You can see that green line on the left-hand side has fallen dramatically since COVID. So really, China is trying to export their way out of this slump. The problem is it's hard to export your way out when you're already the world's largest exporter and you have Donald Trump slapping tariffs on your products. So remain quite cautious on Chinese growth. What really has to happen is Beijing needs to stimulate doing fiscal stimulus, and so far they haven't announced sufficient stimulus to turn the economy around. That has flow-on effects to other countries. So for example, Australia, their major trading partner is China. So we will suffer if China suffers during the next trade war. Now, Australia's growth, as you can see on the left-hand side, is already pretty weak. For 2024, it's been around 1% over the past year. Now, to put that in perspective, if you take out 2020, COVID, it's the lowest level since the 1991 recession. So quite low growth in Australia. We do expect that to improve, but if you look at GDP per capita, it's even weaker at minus 1.45%. So we kept that positive GDP by letting more people enter the country through immigration. Now, unlike the US, the growth we have seen hasn't been through domestic consumption. On the right-hand side, you can see the majority has been through essentially government spending, either fiscal stimulus from the government level or at the state level infrastructure spend. So we do believe that the economy here is weaker than the US, and we should start to see rate cuts come through in February from the RBA. Now, where does that leave us? So we're quite positive on US growth, less positive on the rest of the world, but overall that leaves us positive global equities, in particular US equities. Now, US equities are very expensive. There's no beating around the bush with that. However, as you can see on this slide, on the left-hand side, expectation of future activity is picking up quite substantially. Some activity was looking weak leading into the election as corporates held off CapEx, or I should say capital expenditure spending, and also hiring, waiting to see which way the election swung. Now they have certainty, you can see the assumption of activity will pick up. At the same time, while the US is the most expensive market in the world, on the right-hand side, they consistently deliver on earnings, whereas the rest of the world is more disappointing. So for us, we still believe that US equities are the place to be, especially with the Trump presidency in mind. The problem is, over the next 1 month, everyone has the exact same view. So everyone is very bullish and very strongly positioned. So maybe there might be a washout in the next 1 to 2 months as position gets cleaned after everyone jumped in after the election. So very positive on a 6-month view, a bit more neutral over a 1 to 2 month view. To put it in perspective, on the left-hand side here, when the conference board asked households, how confident are you that equities will outperform or rise in the next year? It's the highest level since the chart began in '87. And if you ask consumers how much of your money is invested in equities, it's the highest percentage since charts began in 1951. So everyone is invested in equities, which makes us a little bit cautious at the moment, especially when we consider duration. We mentioned already that the Fed is less likely to cut rates with such strong growth and strong inflation. So if you think about what the Fed was pricing or what markets were expecting the Fed to do, there was disappointment in December. On this slide on the left-hand side, you can see what the market is pricing for US duration on the left-hand side versus our economic team's view. Our team does believe the Fed might have to think about hiking rates in 2026, and this is not being priced in US duration. So we remain cautious on US duration and prefer countries like Germany and Australia, where the economy is far weaker and less cuts are priced than we think they will deliver. Finally, on credits, you can see here, long story short, red is expensive, green is cheap, but this shows you how tight credit spreads are relative to their own history. US credit, both investment grade and high yield, looks very tight to us. So we prefer to add to countries like Australia and Germany, or Europe I should say, where spreads are far more wide relative to their own history. Also, securitized credits in the US does look attractive, as mortgage-backed securities have a higher spread than average compared to their own history, sitting around more neutral levels compared to corporate credit. Finally, we still like the US dollar. Higher growth, higher inflation, higher rates means higher US dollar compared to other countries. And it's nice hedging portfolios if you do see higher inflation, but also an equity wobble that tends to outperform as markets are panicking. The real return fund still remains pro-risk in its allocation. We have risen cash on the margin for any potential wobbles as we start January. We hope to deploy that capital as we see some market volatility coming into the new year. Looking at equities, it looks like our positioning remains unchanged. We started the quarter at only 37% delta adjusted equities and ended the quarter with the same number. However, under the surface, we did a lot of trading. For example, we added 8 to 9% into US equities before the election, putting our overall equities up to 45% by the end of November. We actually managed to capture most of that rally after the election and then started to de-risk as we entered December, at the start of December, as our concerns over stress positioning started to come into play. So we then reduced our equities and bought some put options to protect us out to February and March. So by the end of the month, it looked like we were back at 37%, but we had a high of 45% during that period. As the market fell, those put options kicked in, reducing our equity weight down to 37%, but under the surface, we still hold 40% equities. We also reduced our duration before the Federal Reserve announced their rate cut in December. We reduced US back-end duration, which helped the portfolio a lot, as that part sold off the most after the Fed announcement. Then we managed to buy that back after the Fed saw yields widen quite substantially. We bought US 2-year bonds, given the yield there was about the same as the cash rate. We found that attractive. At the same time, as spreads narrowed substantially, we took around 5% out of credits and put that into cash. And we also increased our allocation to US dollars by about 5% as we started the quarter. So that actually helped the portfolio offset some of the losses, because as the Aussie dollar fell, obviously our US dollar position helped insulate the portfolio. We remain invested with our preferences being Australian and European credit, not so much as US credit. And at the moment, we have no allocation to global high yield, only Australian high yield. Finally, we hold alternatives like insurance securities, private equity, and private debt in the portfolio to help build in those yields and diversification throughout the portfolio.